For question 14, I'm going to refer to the solution that we have, because if you have this solution in Excel, now there's a number of reasons why it's in Excel. So firstly, when you click on any of these numbers, the last one here was VAT reconciliation, for example, you can see from where the number came. Equally, you can do this for any particular given number. It tells you exactly how the calculation occurred, where the value came from, and the calculation that occurred behind it. So this is all of the T accounts already prepared. So if any of the numbers that we had as part of this video doesn't coincide with this, this is correct. The video was me giving my best guess, which anyway. So these are all the T accounts. When we talk about the T accounts, what we need to do for this question, because it says at the end of the year we pay 16% corporation tax. Now again, back to the idea of a beta. When we said it's earnings before interest, which we covered, taxes, which is this question, depreciation, which we covered, and amortization. So again, this is another financial charge or a charge that occurs after we have calculated, say, our operating performance. To do this, we have to total up all of these accounts and move them to the income statement. So what this question actually means is calculate our profit, and then from that determine how much the tax will be, because a corporation tax is going to be the tax on the profit that we make. In order to do this, I'm going to use the bank account because it is obviously the biggest account that we have. Right, so here you can see, in the bank account, because it's a current asset, you can see we have got the totals here. This is exactly the way it could be laid out. It says bank current asset, it has the total on this side. So by extension we know that all of these are the transactions that have given us, generated money, and this is where we spent money. So we have a whole series of transactions here. In our case we subtotaled the VAT. In the example here we did them separately, but it comes to the same. So what we do is we add up everything on the plus side and subtract everything on the minus side. I know that seems perfectly logical, but naturally that's what we do. And then you put it into the total, remembering no matter, even if the total here was negative, you would still put it on this side. It always, always, always remains on the side where we put the increases. So increases minus decreases gives us our balance. So with this balance, what we're going to do is we need to input this into the income statement. Now the income statement, to do the income statement itself, is literally only taking the numbers that are relative to the income statement and putting them in. Obviously the bank account goes to the balance sheet, not the income statement itself, but that methodology is going to be related to the income statement. Right, so if we come to the second tab here, the income statement and balance sheet, it's the second tab in the file. Within the income statement, you can see that we broke it down by the sales, the room, by each individual department. And we calculated departmental incomes. Now what we have in this, now this is us using the SALI system, but it's just breaking it into the different departments. We've got the rooms, the sales for the rooms, the cost of sales related to the rooms, payroll in relation to expenses, and any direct operating expenses. When we want looking for these numbers, two things. Firstly, if you click on the actual cell itself, it tells you exactly where the number originated so that you can see how that number was determined. But obviously, if we're talking about the room sales, that comes from the sales T account. So like in this case it says T account is F27, so let's go to T account is F27, and here we can see that the sales for the rooms were 450,000. Just as for food was 325,000. So these are all going directly to that, and that's literally it. We're just taking the individual departmental sales numbers from the individual accounts and putting them into the different departments. So 450,000, 325,000, so that's it. Just the same thing. Take a number, putting it into the right place. Cost of sales. Right, now this is where the cost of sales for all of these transactions. Now again, you can click on this, and it's going to tell you from where the number came. But I've made this as easy as I can because the cost of sales naturally incurs a few more calculations. From our point of view, in each of these cases, I have put the cost of sales only as the purchases relation to it. So when we go to say T accounts U4, as it says there, T accounts U4, I've taken from the stock account, which is not incorrect, but obviously here it is. So for rooms it was 76,500, and of course here 76,500. And this carries through, so that's literally how it goes. We just take sales minus the purchases. Payroll and related expenses. Again, if you click on it, it tells you from where it came. But of course, the payroll and related expenses are literally salaries and the social security. So all you do is you take the salaries relating to the rooms and the social security relating to the rooms and add them together. And this is what gives you this number. And then the operating expenses, like that was literally what question was that? Question 11, our direct operating expenses. In question 11, you can see for rooms it was 13,500, and that's it. We just go to the operating expenses T account and N4, and we find the expense relating to that department and put it in. So again, just separate them out. So those are the headings that you're going to use. I mean, it's just the sales and that's cost of sales to see if you're making any money. Then we're going to focus on, say, the service costs or the cost of employees, and then operation costs. And that's literally it, putting the numbers into the right places. You do that for all of the departments. And you find, say, the departmental income of each department, and you add them together. And then we finish the accounts. But there is a slight deviation to this. And that comes when we talk about food. Because in food, the cost of sales is more, or is a bigger transaction than it is in all the others. Now, I did this for specifically to try and keep it as easy as I possibly could, rather than getting you to break it down. But you might have noticed now in the question, in question 3, I said that all discounts were related to food. In question 2, the discount received was on food stock purchase. And the reason I did that was so that only this number would be used. If I say that we received a general discount on everything that we bought, it means you'd have to divide it out between all of these numbers, which just means you're going to be using maths to do this, and that could be where it all goes wrong. So this is more about you understanding the concept, rather than worrying about making sure you get individual calculations, proportional calculations correct. So what this is our cost of sales, exactly the same as it is with the other cost of sales, but in our case here, we are factoring in the discount that we received and the discount that we allowed as additional considerations. So for us, in this case, we're putting in the T account. So you can see it here, U5, U12, and S49. But ultimately, the cost of sales, the purchases, what it cost us to buy the goods, and then we have the discount that we received. If we receive a discount, naturally that means it reduces the cost of us buying the goods. So it's the cost of sales minus the discount that we received. And if we allow a discount, it means that we've had to give people discounts in order for them to buy from us, which means we've had to increase the cost of making the sale. So it's going to be the discount, the purchases, less the discount received, plus the discount that we allowed. But try to understand it from a logical point of view. I mean, it's the same as you buying yourself. If you receive a discount, naturally it costs you less. If you have to give somebody a discount to buy your car, then naturally it means you're making less money. So therefore the cost is technically higher to you. And that's literally it. But when you look at the two T accounts, the T account for the discount received, remember that's 550, but it's going to be negative, so it's already negative. And the T account for the discount allowed, which is 4141, that's going to be positive. So all you need to do is add the three totals together, because the discount received is already going to be a negative number. But that's the only difference between this and all the other cost of sales. But it's also why in the question you will see reference to all discounts being related to food, to make sure that there is no confusion, or there's no need to do it with any other area. So as you can see here, each of them, when we get, say, we've got our sales, cost of sales, employee costs, and operational costs. And here you can see that the calculation for each of them, obviously the sales is our income and everything else is the cost. So sales minus the costs give us our departmental incomes in all of the different departments. We've got 5 departments here, so that's literally how it works for each of the 5 departments. And when we get down here, we just simply add up the amount of money that we made in each of the 5 departments. So all we're doing here is taking the information we had before, filling them in here, taking all the costs away from the sales, and then when we find out how much we made in each individual department, that means we can see how the departments are doing, but then we add them all together to see overall how we are doing. And that's it. The total operated departmental income is going to be the sum there. Right, here we have investment incomes, which we haven't covered that. Now, investment income, remember, that's money that we make from our investments. It is not money that owners or shareholders invest in the company. If we took money and put it into a bank and we earned money from that, we could say it's an investment income, but not the money that the owners invest. Right, so here we go. So I mean, undistributed operating expenses. Right, here we go. We factor in, say, a bad debt allowance in this case. I mean, we put it here, but that's fair enough. We could have taken it from sales, but the same principle applies. And there's a range of different costs. It's a small exercise. I could have put in more costs, but all I would have said is the cost is this, we paid it from the bank or we paid it later. It doesn't improve your knowledge, it just merely extends the question. So there are additional costs there. We haven't had any of these, so we just have that one cost. So again, from our total earlier on, we simply subtract that cost. Our total operating income minus our expenses, if we have any, or maybe there's more, and it gives us here our EBITDA, the fancy word that we've been using the whole way through the exercise. So this is basically how well you have been doing operationally. You've now got your EBITDA. So on sales of €1 million, you've got an EBITDA of 405,000. Perhaps I should have put in a few more costs, but nonetheless, this would be quite an impressive performance in your first year of operation. But anyway, so what we have here is we have got other costs that are drawn into this. So I mean that we have rent, depreciation, interest, and extraordinary gains, as the case might be. So we didn't have any of these costs here. We have depreciation and we have interest. So the depreciation was from the furniture and equipment, and the interest was the interest on the loan. And then down here it says extraordinary costs or gains. In this case, because it is a cost, all of these are technically costs to the business, so I'm putting it in here as just an additional cost. Had I made a gain, I would obviously have had to reflect that this is a negative cost or a positive gain. So I mean, it would have reduced the overall costs. So these are all costs. And again, we've got our EBITDA minus all the costs gives us our income before tax. And that is the point that we need to be at in order to do this question. Because we then are able to say that our tax, which is 16%, so basically it takes this number. I mean, now, the formula here just talks about subtracting any of these, because I also want you to be able to use this for your own accounts if you're actually setting up a business or anything like that, that you would just simply change the numbers, change the titles, whatever like that. But at least the formula will always be there. And in our case here, our EBITDA minus all these costs, which gives us this, by 16%. So that's the 16%. And so this gives us our net income. So in our case here, the tax is 57,211.14. But the calculation of it is certainly more than adequate in the income statement, because we know it's going to be a cost, and we've naturally included it and incurred the cost in this instance. But we must also remember that even though we've got the tax here, we still have to pay it somehow. Remember, when we're doing the T accounts, we have to balance the event that occurs and how that affects our money. And we haven't actually done that account yet. So that's actually what we're going to need to do now. So what we're going to do is we have to create T accounts to actually talk about the tax. So let's see, just switch this across. So in our case here, we've got tax of 57,211. Now what we have got our taxes. Remember, this of course is question 14. We have tax. Now remember, EBITDA, EBITDA, tax. So we know that, so this becomes our tax. Now we can call it corporation tax or corporation tax, which is, again, post-profit cost, a financial charge, however you wish to refer to it. And like all costs, it increases here. So nice and simply, we know that the calculation has already told us that we needed to do this. Now because you've already accounted for it, I understand that maybe you don't see the need for this. But the problem is, we do need to account for the payment. And if we don't actually set this up, which we've already placed in there, you're not going to remember that somewhere out there you need to account for the payment. And we know that 57,211.14 is going to be the payment. We're making a payment, so certainly it's either going to be a current liability, as in we're paying it later, which would be an increase in our current liabilities, or it's going to be cash or bank by reducing the balances of the same. And this is why you need to have this part done before you can do your balance sheet, because if you totaled up the bank, then this is obviously going to be a change to the balance you have in it. So we said to be paid in 3 months. So in our case here, we know that because we're going to pay it within the next year, it's a liability, and because it's less than 12 months, it's a current liability, which means it's plus. And as we know, we're just going to call it what it is, corporation tax, and as all current liabilities are, it is payable. So that is the T account that we need to do for this. Only possible when you complete the income statement. But that is how you do question 14.